The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
You are listening to the Ascent with Crestmont Private Wealth. This is Alec Walker, EVP of Financial Planning and Equity Partner here at Crestmont Private Wealth, broadcasting live from our Houston remote radio broadcasting studio. Today's episode, we're going to be talking about restricted stock units, or RSUs. So generally this time of year, February, March, April, is when restricted stock units, or RSUs, are being granted or vested, and there's some decisions to be made. So we wanted to talk through that and give a high-level overview of what RSUs are, how to handle them, what are some of the tax implications, what are some of the planning techniques that we do around RSU time to set our clients up for success in the near term, kind of handling those near-term tax consequences and income, as well as long-term. So high level, what are restricted stock units? RSUs are a promise from your employer to give you company stock on a specified date if you are still employed at that future time. So as an example, if you join a company brand new and part of their compensation plan for employees is RSUs, you may be granted an allotment of 100 shares of that company stock, and that stock will begin vesting for you, say if you're still employed 3 years later. So there's generally a waiting time there until those RSUs are granted. Now, what that vesting schedule is there for is a little bit of kind of a golden handcuffs. You know, they want you to stay with the company, provide value, increase shareholder value, of course, so that then you get that benefit in the future. For other folks, maybe you've been with a company for a while, each year around that RSU time, around that kind of annual company benefits review time, you may be granted another set of those restricted stock units each year. So for clients that we work with, every February, March, April, we may be having units that are vesting, that the client is now actually taking control of those previous grants. And at the same time, they're getting a new set of grants. So we'll talk a little bit more about this as it relates to overconcentration and diversification to RSUs later on in the discussion. Now, the one difference I kind of wanted to highlight here, people think that restricted stock units, they can confuse them with stock options. The big difference there between those two is that stock options, you generally have to pay for those. So you're granted options at a specific price, maybe $5, $10 per share, and you have to actually come up with the cash or sell shares to purchase those options. Totally different as it relates to restricted stock. You are simply granted those shares. You don't have to come out of pocket with any cash to purchase those shares. They're granted to you by the company, and you simply are left with what are the tax implications, the income implications of that stock. So let's pivot. Let's talk about what are the tax implications. So you're a new employee, you join the company, you're granted RSUs that are going to vest within 3 years. Let's say it's 100 shares and it's going to vest 25 shares each year over a 4-year period, but it won't start for 3 years. There's no tax implications upon the granting of those shares. That's just a future promise from the company. When the tax does occur is upon vesting. So when you actually are able to, called incidental ownership or economic benefit, when you have the ability to then sell that stock and use the proceeds, that's when the shares are then taxed. And the taxation for that vesting is the fair market value of the shares upon vesting is taxed as ordinary. Generally, companies will withhold federal income taxes from this withholding in the amount of usually shares. So, if it's $100,000 worth of stock that is vested for you, generally the company will withhold about $22,000 for federal income taxes, as well as additional payroll taxes, Medicare, Social Security taxes as well. You are listening to The Ascent with Crestmont Private Wealth. This is Alec Walker. We are talking about RSUs and specifically the tax implication of those RSUs. So as I just stated, when RSUs vest, that fair market value is treated as taxable income. So you can imagine over a 3-year period, that income or the value of those shares upon grant versus when they vest could be wildly different. The stock could go way up, and so the income when it vests for you is much higher, or it could be much lower. The stock could go way down in value, and so the income that you receive is a little bit less than expected. So that's the first phase of tax implication, is the ordinary income upon vesting. Now, the second piece of taxable income is the capital gains tax. So once the stock vests, the fair market value, let's say it's $100 per share, that vest value becomes the cost basis. So that cost basis becomes the basis for your future capital gains when you decide to sell that stock. So if you were to sell that stock immediately upon vesting, you'd be subject to short-term capital gains or short-term capital losses, depending on what the value fluctuation is between the time it vests and the time you sell. Or if you decided to hold that stock for over a year, then you would be subject to long-term capital gains or losses, with that vest date being the point at which that clock starts for the long-term capital gains clock. So very important to make sure that whatever custodian is handling the restricted stock is accurately tracking that cost basis. So when we talk about these kind of tax implications with stock, it happens automatically. There's a set date of when that stock is going to vest. Usually taxes are withheld automatically. So what are we doing with clients? I would say there's a lot that we're doing with clients around this time. And probably the main thing that we're doing is we're getting the vesting confirmations, the grant confirmations from our clients. We're looking at their most recent pay stubs. We're comparing that to their previous year tax returns. And we're seeing, okay, based on what we're showing as income from this stock, as well as your other income that we're projecting throughout the year, was this 22% tax withholding that they automatically processed? Was this enough, or was this too much? Many times what we see with our clients is that tax withholding is not enough, particularly if there's strong performance in the stock and that vesting value is much higher than expected. So this is where we're running some analysis and calculations to determine, okay, do we need to be making an estimated tax payment to avoid a underpayment penalty to the IRS next year? Or do we need to be increasing our tax withholding on our paychecks throughout the year to account for that under withholding that the company did? So that's number one that we're doing, is we're really taking a deep dive into the tax implications. And then in terms of, other things that you could be doing, if that income is much higher with the vesting of the stock, maybe we can donate some other highly appreciated stock, doing some charitable giving to a donor advised fund to increase our deductions and offset some of that income that's coming through from the restricted stock units. Usually we want to be contributing long-term assets. So maybe this is some RSUs in a previous year that we didn't sell that is highly appreciated, or some highly appreciated stock that is not any restricted stock units. So those are some things we're doing to look at potentially minimizing taxes. You're listening to the Ascent with Crestmont Private Wealth. I'm Alec Walker, EVP of our Financial Planning Group. Today, we've been talking about RSUs and restricted stock units. We just covered some of the tax implications of RSU, ordinary income upon vest, capital gains upon the sale of that stock, whether that be short or long-term, depending on the timing of the sale. And so now we're talking a little bit about the diversification and the risk management of RSUs. So as I mentioned at the top, when you work with a company that does restricted stock units, the value of that stock as a percentage of your portfolio can really increase over time as you're getting stock that's vesting in a new grant and a new vesting and a new grant year after year after year. We've seen the value of stock in a client's portfolio rise to over 50% of their total liquid net worth. And that can pose a pretty big problem, because what that does is now it puts you in a position of having to sell and generate a large capital gains just to minimize the over concentration risk that you've generated. So generally what we recommend is when that stock vests, sell it as soon as possible. By doing that, you're able to generate either a small short-term capital gain or a small short-term capital loss. The reason we recommend doing that versus saying, let's wait a year so that we've got long-term capital gains or long-term capital losses, generally poses two problems. Number one, if the stock performs really well, now you're looking at a long-term capital gain. And we've just seen this many times where a client's like, well, this is going to be, much higher than had I just sold it very quickly at a short-term capital gain. And then you're in a position where that over-concentration risk just starts to build and build, because now you've got a new grant of RSUs. So the value of your relative to your overall portfolio is increased. Or in the inverse, well, the stock has gone down since it vested, and you're kind of anchoring to what that previous price was upon vest and saying, well, I'm going to wait till it recovers, and then I'll sell it when it gets back to that initial vesting point. Same position. Now you're still remaining in that over concentration. If you need to repeat that year after year, you kind of put yourself in a tight position. What we generally recommend, again, selling it as soon as possible. That way you're creating a diversified portfolio from the start. And if that diversified portfolio goes up in value or goes down in value, you're either A, not tempted to sell it if it goes up in value. You're not forced to be like, I really need to sell because I'm over concentrated. You're diversified. Or B, if it goes down in value, well, with a diversified portfolio, maybe we're implementing some tax loss harvesting strategies at that point. So it's really vital, we think, in diversifying to minimize that risk exposure and minimize that over concentration risk. And at the same time, as you're getting new grants that you can't access because they haven't vested, you still have exposure to the growth of the company stock. So you still have exposure through your unvested RSUs, but we recommend diversifying those vested RSUs. Now, there's a couple unique strategies that we've obviously been doing this for clients for over 10 years now, but over the last handful of years, we've implemented a couple unique, we call them satellite equity strategies. We've got one called the Focus, one called the CPW Equity Income. So this is a great way for clients who have a concentrated strategy to diversify over 25 to 30 individual stocks, but still have a relatively concentrated portfolio, exposure to individual equities that's a bit more concentrated than the broader market. And we think that that's a great kind of middle ground for someone who's wanting to maintain some individual equity exposure, but is able to get that diversification that we think is in their best interest in the near term, as well as for the long term. We think about the exposure that you've got to a company. It's healthcare, it's your salary, it's your bonus, it's 401k matching, it's all these benefits. If we can unwind a little bit of that by diversifying restricted stock units, we'd call that a big win for our clients. You've been listening to the Ascent with Crestmont Private Wealth. I'm Alec Walker, here from our Houston office located near the Galleria and Memorial Park in Houston, Texas. We also have an office in Bernie, Texas on Main Street. If you have any questions about restricted stock units, your own personal tax situation, please reach out to our team. You can contact me directly via Alec, ALEC, at CrestmontPW.com, or visit our website or email us at info@CrestmontPW.com. Hope you have a great day. Thank you.